Alright, guys, welcome back to episode 7. We'll be doing risk management. Don't forget to like and subscribe, and let's get into it. Now, first and foremost, why do traders blow account? Well, that's actually easy. It is emotions. What emotion specifically? It would be fear and greed. One of the key things you need to understand is you're human, right? You lose trade and you can't really do much about it once you've lost the trade, right? Just move on from it. However, no matter how good we are going to be making lapse in judgment. If we can catch ourselves before doing these things, then it's even good. So emotions is one thing. Then you have revenge trading and stills rather than emotions. So revenge trading is constantly going back to get what you have lost. If you have $100 in your account, you take a trade and then you go and say, well, I lost $10. You take a next trade, you want back that $10. No, that's greed kicking in. However, it's still under revenge trading. Now you want to prove to the market that you're going to take revenge and milk it. Market is going to teach you a very good lesson as to why that does not work. And then you'll be at 120, 150, you're back to 80. Because now you have now over leveraged the account. It's another thing. Once you over leverage the account, you are entering a lot size or taking a trade that simply cannot keep up with what you have. Right? So, three things: your emotions, specifically fear and greed, and those can go into revenge trading from fear, or greed, which is over leverage the account, thinking you are better than the market when in totality you are not. Now, there are key things that they can do, which is put up little reminders in front of you, sticky notes, and paste something on the wall, a picture frame. You can put software limitations on the software that you're using to not execute any more trades. I know that the futures platform does this. I'm not sure about MetaTrader 5. You can delete the app once you've made a loss or win for the day. There are other things you can do, but you get the gist of it. Just to prevent you from losing that hard-earned capital. Now, with that hard-earned capital, you need to know how much risk you need to take per trade. Let's use you have $100. That's standard, right? $100, 100 USD to be specific. That's YSD, 100 USD. Oh, 100 USD. Now, this capital, it's not a lot. However, compound interest is king, and Warren Buffett exists to be a rich man because of it. You aren't going to be flipping this like what everybody else does. By the way, when you see they're flipping those accounts, it's real. However, guess what? They have the capital. So when they finally get that good trade, they flip the accounts and you know they're on a run. They post it. Then show you guys that it's possible to flip when in reality this is not just the case. Not everybody has $1,000. You can split up into 10, $100 and do it until you get it right. Now, our risk per trade would be 1% of the account. 1% would be $10. So we are looking at 1% of the account, right? Oh, my bad, guys, not 1% is actually $1. Now, in totality, you can actually risk 1% of the account if you actually have $100. That's not actually realistic speaking, so I'd actually tell you guys to go for more since the account is small, but we'll be going with 10% max. You need to take 10 trades in order to blow this account. 10% is actually $10. If you take a $10 trade, right, you lose, you're now down to 90. If you win, you're up to 110. Then you keep repeat until you're at another marker, which I would give to be a 1, 3, 5, 7. Use odd numbers. There's a specific reason why I say to use odd numbers. Odd numbers give you more leverage. If you lose $100 from $300, you have 200 leave versus having $200 and losing 100, and now you're back to your starting capital. So a rule that I do is use odd numbers before you increase the amount you want to risk. So with $100, 10%, risking 10%, and before we even up the ante, which would be, let's say, 20%, or we can still keep 10%, because 10% of 300, it's 30. So we can increment it and keep going as we go, if you get the gist of it. Or we can lower the number to 5%. So let's say we have 300, and we want to do 5%. That would actually be 15. I just did the calculations just now, guys. So that would actually be 15. So we can still keep using our same 10%. That would give us 30, or can go half, and that's 15. And then, as I said, use odd numbers before increasing the amount you're going to risk per trade. All right, risk to reward ratio. That is basically, sorry about that, guys. Risk to reward ratio. That is basically where you want to set where you're going to be taking a trade. So you have your 1 to 2, or your 1 to 3, or your 1 to 4. Right? So if you want to know what it actually means, it's you're risking whatever you're risking on the account. For example, up here, you see 10%, you're looking to make 20%, or in dollars, you're risking $10 right here to make $20. You're risking $10 to make $30. You're risking, yes, it changes, $10 to make $40. But a visual representation of that, let me just come to full screen from here and go on the chart here, you guys can see. Let's just reset the chart view. Like that. I'll just be putting this anywhere. Let's just take a short. Alright, so as you guys can see, risk to reward ratio right here. It's something that is on the trading view, and this is dependent on how you set a stop loss or whatsoever. So if I wanted to take a 1 to 2, you can see as I adjust it. There you go. That's 2. So my trade starts there. And my trade would actually end. Let's just adjust it. So yes, there it is. So if I enter, that's where my trade would actually end all the way down there. Versus if I take a 1 to 1, look at what happens. I'm in the trade shorter, and I just need risk 10 for 10 versus I have to wait all this time before I make $20. Mind you, each candle is a hour, and this is why I trade on the smaller time frames, which is the 15 and 5 minutes. But this is just an example, guys. So let's just switch back, jump back into full screen, and let's continue. Now, our position sizing. Now, with there's no flat position. That's the true thing. There's no flat position. Each individual pair has its lowest lot size and its highest lot size. We'll be focusing on most of the lowest lot size. You guys will see it when I'm doing my live trades and working with MT5 and executing the trades inside of there. Position sizing can be 0.1, 0.5, but if you're working with a small amount, just work with the lowest lot size and increase over time. The 1 to 2% rule, that comes back to how much you are risking per trade. However, in this instant, we'll be using 1 to 2%. Reason being, and why I have it here, it's, you see, when you have like 1,000, 5,000, then risking 1% actually makes sense, because if you have 5,000 and you're risking, like, let's say, let me just do the calculation. Let's say you have 2,000, right? And you want to risk 1% of that. That's 20. That's actually quite small. So they'll typically tell you to risk 1 to 2%, but in totality, it's still small with a $2,000. So you would not believe who that 1 to 2% actually applies to. Yes, $100,000 you'll be risking that amount. Matter of fact, let me just show you guys the calculator. Everything correctly. Just pull up the calculator so you guys can see it. Alright. If we have 100,000, right? We multiply that by 0.01, that's 1%, that's 1,000. Versus having, let's see, 2,000, multiply that by 1, that's just $20. That's a tad bit. So we'll be increasing the amount since we're working with a small amount to actually see progress from the trades. I call it progress because if you're making $1, $2, a lot of persons are going to say, all right, I'm not making any money. Yes, it can be used as discipline, but realistically, trading is a way to make money. You want to see some form of return, something realistic. So that's why I say use 5 to 10%. Protecting your capital. You're actually fighting a war. and you're defending your capital. So, with everything said, emotions try to take control over them. No revenge trading, no over leveraging. Set a fixed amount that you're going to risk. Have your trading setup. Have your A plus, your B, and your C setups. If you don't see anything for the day, then you walk away. Remember, guys, if you don't see anything for the day, walk away. Do not force the market to do your bidding, and then it takes away your capital. All right, so that's about some stuff for this episode. See you next one, guys. Peace.